All right, so the year under audit is year 6. And during the course of the year 6 audit, the auditor discovers the following situations that may or may not require an adjusting or correcting journal entry. See, a lot of candidates, they see journal entries on the audit exam in the middle of their exam and they just go berserk. They're like, why are they asking me journal entries? That was far. This is auditing. Well, level out, because you're going to have to know GAAP rules to pass audit. Because the only way you could be a good auditor is if you know what the client's journal entries should have been under the circumstances. Otherwise, how could you give an opinion that's worth anything if you don't know what the client should have recorded as debits and credits at year end? So expect journal entries on the audit exam. Correcting entries, adjusting entries. If an adjusting or correcting journal entry is required, determine the debit or credit. If no entry is required, select no entry. All right, number 1. The bank's confirmation reply regarding the company's line of credit indicated that the December year 6 interest was unpaid at year end. So the company has a line of credit with the bank. We confirmed it, and they said, and by the way, the client didn't make their interest payment by December 31st. Accruals for monthly interest expense have been made for 11 months in year 6 by the company.
So you need to accrue that one, that last month's interest.
You do.
Debit interest, credit accrual.
Debit interest expense, credit interest payable, and that should be your adjusting entry at year end. This is an example of an accrual. An accrual means income statement this year, cash next year. So even though they didn't pay it, it's still an expense of the current period, and it's going to go against income, and it's going to be charged against net income to make net income lower. And this will get the auditor's attention, because the auditor will think that the company deliberately left this entry out just to keep net income at a certain level. Because as you leave out expenses, net income pops up. As you put down these expenses and include them and accrue them, net income falls. So what company would want to do this kind of entry? They don't want to do it, but they got to do it. And the auditor is going to find it and mention it.
But they also have to take into account materiality levels, right?
Number 2, employee overtime pay for hours worked before year end, but paid in the following year were not recorded until January 5th, year 7. So this is overtime pay. Employees worked before year end, but they didn't get paid their overtime until after year end, and these entries were not recorded until January 5th, year 7. But since the overtime was incurred in the year under audit, what should the entry have been?
Additional salary expense and accrued salary.
Yes, wages expense debit, credit wages payable. Just another accrued expense. Income statement this year, cash next year. The auditor is interested in these expenses being included in this year's income statement. And the auditor will say, if you don't include this, I can't give you an unmodified opinion, because you're cooking the books. You're making net income higher by leaving out these expenses. Number 3, in the last week of year 6, the company recorded revenue for services rendered in year 7.
So this is the opposite on the revenues.
Right, this is too aggressive here with revenue. Reduce the revenue, reduce accounts receivable. And that's how you reduce the overstatement of revenue. Once again, the auditor would be very concerned that they're cooking the books here by recording revenue too soon. Number 4, during year 6, a former employee sued the company for unlawful termination. Legal counsel has advised the company that it is reasonably possible that the company will be assessed damages. That means they're going to lose. The company's going to lose and have to pay this former employee. An amount can be estimated.
disclosure?
Yes, reasonably possible is not probable, hasn't risen to the level of something you have to book. It's just something that they should footnote. So the no journal entry required. That's what you would choose here. Unless it rose to the level of probable, then you would have to accrue it. Probable and estimable. And then let's go over that rule, because there is that rule that says if it is estimable, but they can't come up with an exact amount, but they can come up with a range of possible losses. Now, this wouldn't apply to this particular question, but I could see them giving you this on the audit exam. If the company picked an amount based on a range of losses under US GAAP, let's say they came up with a range of potential losses to be between $1 million and $4 million, what should they book, assuming this rose to the level of probable? What amount should they book as the loss if there was a range of losses under US GAAP between $1 million and $4 million? Should you be the most conservative and book the $4 million loss? Or should you pick the lowest possible in the range of losses, the minimum in the range? Or should you go with the midpoint? Is there a rule about it, or can you just kind of wing it and pick whatever you want? The exam question will be specific and clear and say, no amount of loss is any more likely than any other within the range. But here's the range, $1 million to $4 million. What do you choose under US GAAP? You choose the minimum. You should book the $1 million, not the $4 million, but the minimum. Why is that? I mean, we're such a conservative bunch. Why wouldn't we book the $4 million?
Because it's gonna not gonna look too well.
Well, we booked the $1 million, we booked the minimum, but we disclosed the potential $3 million additional damage. We have to disclose that. But why don't we book the $4 million? Because if we book the $4 million, we're setting ourselves up for something later on that we'd rather not do. So let's say we book the $4 million, be real conservative, but then it turns out we only lose $1 million. That's the actual damages. When we reverse out the liability, because what would the journal entry be if we booked this thing? We would debit what? Debit a loss, right? An estimated loss for a lawsuit, and then we would credit a liability. And then let's say we booked the $4 million one. When it turns out we only lost $1 million, we have to reverse out that liability by debiting it for $3 million. We're setting ourselves up for something we'd rather not do, and that would be crediting a gain for $3 million, because we already booked a loss of $4 and we only had damages of $1, so we'd be crediting a gain. We really don't want to credit a gain in this moment, right? So that's why we booked the minimum. We disclose the rest of the potential damage, but we only book the minimum of the range of losses. That's if there's a range. If we know what the loss is, we book it, but we usually don't on the exam. We usually say the range is this. What do we do? If it's probable, we book the minimum in the range. But in this case, it wasn't even probable. It was only reasonably possible, so we don't book anything.
So if it was the other way around, it was 2 million and you booked 1.
At the end of year 6, the year under audit, a major customer filed for bankruptcy. What's the journal entry when a major customer or somebody files for bankruptcy and you have to write off a bad debt?
Just disclose it, right?
You're going to debit the allowance and credit accounts receivable, whatever the amount is. Debit the allowance, credit accounts receivable. Notice you will not touch the income statement, though. Don't debit bad debt expense there. Why not?
Because you've already accounted for it.
That's right. You've already accounted for it, supposedly. Bad debt expense should be estimated based on your sales activity for the year or your accounts receivable balance at the end of the year. So when you have actual write-offs, that doesn't involve the income statement, but it is a journal entry that needed to be made, and there it is, debit allowance, credit accounts receivable. Goods in the shipping area were excluded from inventory. They didn't count these. although shipment was not made until January 2nd, year 7, so it looks like they probably should have included these goods. The goods were billed on account for $100,000 on December 30th, year 6. They were shipped FOB shipping point, but they never made it out of the company. In year 6, they were still there until January 2nd, year 7, with a cost of $80,000. So what kind of entry should we make here? It says they were excluded from inventory and the goods were billed on account $100,000. So it looks like they recorded the sale and they never included the inventory, so they relieved themselves of the inventory. So you're going to have to make your usual entry here to turn around the sale and put the inventory back. Debit sales $100,000, credit accounts receivable, debit inventory, credit cost of goods sold, because these were the entries that were erroneously made. These entries would have been fine if the goods would have been shipped by December 31st, but they were not. And that's why they overstated sales here. The company purchased inventory on account for $16,000, which was shipped FOB shipping point from the vendor on December 23rd, year 6. This is a purchase now, not a sale. And it was FOB shipping point, so usually you're the owner right away as soon as the goods leave the seller's loading dock. If it's FOB shipping point and you're the buyer, you're taking title right away on this. The inventory was received January 3rd, year 7, but it really doesn't matter when it was received under FOB shipping point. It matters when it was shipped. And the transaction was recorded January 3rd, year 7, but looks like they should have recorded this in the year under audit because they did take title. So they should debit inventory and credit accounts payable in the year under audit and not wait until the subsequent year. So it said the $16,000 was the inventory. That's what you should put on your books as of the end of the year, and credit accounts payable. So what are we doing? We're adjusting and correcting entries the way an auditor would, and these are the same kind of questions you're going to see. Number 8, inventory sold on December 30th, year 6 for $15,000 on account were shipped on December 31st, year 6. Okay, they were shipped by the end of the year. That's good. But look at the terms of sale. Destination. So it doesn't matter when they shipped out. It matters when they arrived. And they were still in transit because they didn't arrive until January 2nd, year 7. So these goods still belong to the seller at year end. It's not a sale yet. Not a sale until the goods arrive under FOB destination. So the goods transferred title, but not until the following year. And that's when the transaction was recorded. Look what it says. The transaction was recorded when? January 2nd, year 7. And that's when it should have been recorded. So no journal entry is required. No adjustment, no correction, because it looks like they did record it at the right time.